Canada has increased interest rates another fraction. Apparently the economy is doing well and everything is just fine. The real estate market is completely overheated, but let's not focus on that. Instead, let's all thank the Prime Minister with the best hair and celebrate. You came here for the truth, so let me unveil that for you. Today we're going to look at the situation in Canada. Let's begin. Starting with the economy. At 5.7%, the jobless rate is at a level that most economists associate with full employment. That's right. If you go downtown Toronto, you won't see every street corner riddled with people sleeping on the streets in the freezing cold. So many that the shelters were beyond full capacity. And then you go to Vancouver, no, you won't see that either. Every street corner. Well, on paper, the economy doesn't need more stimulus. Right, because everything's just fine. The Bank of Canada said, while we do think everything is just fine, let's just cool it a little bit. Let's just take a step back. Let's not get carried away here. Well, they decided to increase interest rates to 1.25%. And while the financial media suggests that this is because everything is just fine, understand that we are at a level that we were at approximately a decade ago. And it's taken all this time of basically being all the way at the bottom to being up just a fraction of a percent. Now you look at it on this chart, it's a significant increase, definitely. But when you look at it over a period of time, larger than this, you see the reality. 1.25% is extremely low. But they don't like to cover it like that because of course it makes the economy look weak. But I will tell you something. When you look at interest rates, we see 1.25%. But how that affects everything else down the line is something that everybody needs to understand. So let's get into some of those factors today. The big six Canadian banks have now all hiked mortgage rates ahead of a Bank of Canada policy announcement. That was today. And fixed rate mortgages are now finding themselves at 5.14%. They were at 4.99% before. Ultimately, if the central bank is increasing, so will the commercial banks. I think that they will see this as an opportunity to continuously increase the rates, regardless of what the central bank does. In fact, they had done that at one point, and I covered it here on this channel. They thought that the central bank would do so at some point, so they increased them. That's the way it is. And then they'll increase them again when the central bank decides. Of course, they have to stay competitive. That's a factor. Now, there's a website I want to show you here because I've seen this site before and I've shown you this, and I want to clarify this. This is RateHub, bank mortgage rates. What you're seeing at the bottom of the screen is 3.49% for a 5-year fixed term. That doesn't seem to be the case at Scotia because when I actually go to the Scotiabank website, it confirms what I read to you in the article, 5.14% for a 5-year. By the way, I do recommend a longer term, lock it in, fixed rate, do not risk anything. So what I'm saying to you is be careful where you get your information from. Just go right to the source. If you're going to look at a particular institution, just go right to there. Don't use one of these rate matching. Just get an idea, but then to make your calculations, always head to the actual website of the company you want to go with. All right. They're basically talking about how, they've been increasing. This is going to make it more difficult for home buyers to qualify for mortgages, particularly with the new stricter guidelines. The central bank confirmed that the cost of money is going up, citing stronger employment, not true, and GDP growth in 2017, as well as increased activity in residential investment and consumption by consumers. People are at the maximum debt they have ever been in Canada. The last time I showed you the statistics, it was approximately 67% debt to income ratio. That's not good. All right. New higher interest rates and stricter mortgage guidelines, residential home sales may tend to slow going forward. Of course, because they're worried about what will happen. And then we look at this. Yes, they've increased the benchmark rate to 1.25%. That's going to drive up variable mortgages and consumer loans. Now think about this for a second here. They had the actual statistics, and I wanted to bring this to you. I think it's really important, and this is why I think 2018 could be a very, very interesting year, particularly in Canada because of this. But it applies to any other country. If your central bank, wherever you live, is doing the same thing, think about this, okay? We have a bubble in real estate, and it's not just in Canada, it's in many countries. The 0.25% increase, which technically is a fractional percent, right? They're doing so at the minimum. You can't get any more minimum than this. But that 0.25% increase would mean an additional $52 a month or $624 per year on payments of a $400,000 5-year variable rate loan over 25 years. All right. Think about this for 1 second. If you are in Canada, if you're in Toronto, Vancouver, one of the more populated cities, which, hey, that's where most people live, $400,000 is not going to buy you a real home. Maybe you can get a 1-bedroom in a less desirable location, a 1-bedroom condo. $400,000, even if you were to go into the suburbs, you'd have to go way out into the suburbs, right? So $400,000 is not realistic anyway. So let's play with these numbers a bit. It increased in September, if my memory serves correctly, and it increased again just now, January 2018. So in that period of time, the rates increased by 0.5%. If we extrapolate, we're looking at $100 a month difference, okay? I hope you'll agree with me on that. We also have to factor in $400,000 is really not that much. I mean, realistically, a lot of the places are going for 600, even it depends on the area, of course, but 600,000 is, if you're buying something for 600,000 is very, very cheap. It's probably a condo, not a house. A house is going to cost you a lot more than that, probably twice as much as that realistically. So the percentage increase is going to be a lot larger. We're talking about, instead of this 52, maybe it's 100, maybe it's even 200. So I don't know how to factor it. It depends, okay? There's a lot of factors here ultimately to look at. But I would say since September till today, now that they've increased, so before September until currently today, we are looking at minimum $100 to $200 per month that people are seeing an increase in their payments, right? $200, even $50 for some people, not a big deal. But look at the statistics that I found here, okay? Look at this. 1/3 of Canadians say that they are now unable to cover their monthly bills while keeping up with their debt repayments. Up 8 points in the index in September. 1/3. 1/3. That's now, right? Think about this. Households that are still making ends meet have around $630 left at the end of the month. That's down nearly 30% from $890. Okay, not that long ago. And overall, almost half of Canadians, 48%, said that they are within, check this out, $200 of not being able to meet their financial obligations. Over 40% are worried they'll be in financial trouble if interest rates keep rising, with the 1 in 3 afraid they may face bankruptcy. I just told you $200 increase. Some people have just experienced that from before September till today. This is becoming a critical situation that is not being addressed. Now, I don't think that they should keep interest rates low. I think they should be higher. Let me be clear about that. But it's going to cause a recession. And they're worried sick about that. There's too much debt. We need to see bankruptcies. We need to see homes that go basically bust. That's the way it has to be. It's not a good thing, but that's what it's needed. An economic detox is what you need. The alcoholic doesn't need more drinks. Okay? They need to get that out of their system. It's painful, it sucks, but that's just what it needs. Look, I'm warning about this right now. I took the entire video basically to show you this. $200 increase. Many Canadians are feeling that right now. Or, hey, whenever they decide to increase the next time, maybe it's June, maybe it's July. I don't know when they'll do it, but it's coming up at some point in the near future. That's another $50 to $200, depending on many factors, of course. And that's going to just destroy people. I'm warning about it. I'll be ridiculed. That's cool. We'll call this the ridiculed GPS. And I wanted to say one more thing. I think that the central bank in the US, the Federal Reserve, doesn't have a sense of humor. But in Canada, they do. And that's where I'll give them credit. The Bank of Canada is definitely a very, very funny institution. Look at this. They actually told the joke right on their front page here. We are Canada's central bank. We work to preserve the value of money by keeping inflation low and stable. I mean, this is amazing. They put the jokes right on the front page. Congratulations to the Bank of Canada. You win. I want the Queen to wear that crown, parade around Canada, call herself the Queen of Canada, and do all those acts that we know that they do, and I'll just stop right there, zip in my mouth. That's all for this video. If you found it informative, please give me a thumbs up. If you like my terrible comedy, please give me a thumbs up. If you hate it, give me a thumbs down. Last but not least, if you found the video informative, I know you will find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. I promise there are no terrible stand-up comedy acts in the books, but if you want to look through them, check them out at Amazon. Links are in the description below. Take care.